so desperate on my knees to break. And I hear the voice of an angel telling me not to lay it down. And I feel the spirit guiding, telling me not to.
All right, what is up, guys? John Fibonacci here, and I know it's been some time, right, since I've posted to YouTube. I've taken another hiatus, all right, but that's only because I stream for the IM Mastery Academy Go Live platform, and for the Bounce Back London Open sessions for the Bounce Back product through the IM Mastery Academy. So all my time is spent there and with private students, with private videos and things of that nature. So I wanted to give the public a little bit of stuff, and I know some of you guys looked, through a lot of my YouTube and things like that, and I actually took a lot of videos down. I kept a couple of them up there, the more popular ones and the ones that, are good, but they're not like amazing, because of course I'm not going to spill 100% of the beans on YouTube like some people try to do, but don't do it very well. So today I want to talk about the logic behind the Fibonacci, right? The secret to the Fibonacci tool, retracement tool. I guess it could go for extensions as well, but today I'm really going to focus on the Fibonacci retracement tool. So, and go figure, right? My name is John Fibonacci, but that doesn't really have to do anything with it. You guys know I can teach a lot of different concepts, but nonetheless, the Fibonacci tool, right? So, basically, what you have, right, when you draw, let's say, a low to a high, right? You have low and you have high, right? So basically, the secret to the Fibonacci tool is not the levels itself. It's not the 50% or the 61.8% or 786%. Those are what I use. You can see that on the screen. It's not the levels, right? It's not the math. Even though the math, actually, if you do actually some research and you go look up the Fibonacci sequence and the golden ratio and all that other stuff, it's actually pretty interesting. But it's not that type of math, okay? It's the logic behind what those numbers represent. So when you measure from a low to a high, right, you essentially have price that is low and then price that is high. So in terms of supply and demand, I don't believe in supply and demand. So let's step away from price action for a second, and let's just think logically about supply and demand pricing for anything. I mean, it could be products. One of my personal favorite analogies to use is the sodas, right? Soda cans, they used to be like 50 cents at the vending machines, and then now they're like up to 75 cents and things like that, of course, if you don't take inflation into account. But so what I want you to think of, imagine those 50 cents, right, for those sodas. Now imagine those sodas at the same price were like 25 cents down here, right? So if they're already selling for 50 cents, imagine what the demand would be like if the price of those sodas were to go down to 25 cents, right? Those soda machines would be selling out like crazy, right? Because it's cheaper. So when demand stays the same, the demand would increase because the price is lower, right? So then supply would go down because people would want, many more sodas at 25 cents. So it would make sense, no pun intended, it wouldn't make logical sense for the people who are selling soda cans to keep the price at 25 cents, right? They could up it to, let's say, 75 cents, right? That's not a 7. That's not really a 7 either. Trading View's thing is crazy. right? So now let's say the price automatically jumps to 75 cents. Now, some people who still want soda and they like it, they might be willing to pay 75 cents, but there's going to be a less number of people willing to pay 75 cents for those soda cans. And so you won't have that many number of buyers here. So 25 cents is too cheap, right? 75 cents is too expensive. So what usually happens is the sellers of the sodas will say, okay, well, we'll meet in the middle, right? And we will sell our soda cans at 50 cents a piece. So not too cheap, not too expensive. It's right in the middle, between low and high, right? So it's kind of like when you negotiate, right? You ever negotiated the price of something? Oh, I'll offer you this, and it's usually a low ball, and the seller is usually selling it too high. And during a typical negotiation, you'll meet somewhere in the middle, right? Not 100% of the time, of course, but majority of the time you see that often where uh, the buyer and the seller usually meet at about the halfway point. And so that's kind of the same concept here as well. So again, 25 cents is too cheap, 75 cents is too expensive, and 50 cents is right in the middle. So that same logic applies with the Fibonacci level. So if your buying price at whatever this is low, and then you see price rally away, well, you don't want to buy price after it already rallied higher, right? You don't want to do that. You want to wait for price to come down. Now, when price comes down to the 50% Fibonacci level, that's a pretty decent price. It's halfway between the lowest point and the highest point, right? Right in the middle. So it's okay. It's not ideal, but you're not really paying too much or too little, right? Now, the logic is when price comes down to 61.8% or even the 78.6%, you're getting it more in favor on the buy side, right? So it's kind of the same scenario. Let's go back to the cans for a second. 25 cents a can, 75 cents a can, then it comes back to 50 cents. So you're okay with paying 50 cents for the sodas. So what would happen if the sodas all of a sudden went to, let's say, 40 cents, right? Well, 40 cents is better than paying 50 cents, right? So that is a better price to buy something at, right? 61.8% off of the high measured from the low to the high, right? And then 786, could be something else like 35 cents. I don't know. I'm just making up the numbers, okay? So the logic is buying something cheaper and cheaper is more ideal. Now in Forex, I do believe that prices are heavily manipulated, and really price runs lows and runs highs, in order to meet liquidity that is not represented with candlesticks, but rather outside of the candlesticks. So it's going to be different for every single trade, but when you go and you study Fibonacci levels, you'll see the logic of what I'm talking about. And of course, if we're looking for a shorting opportunity, it would be everything here but flipped, right? Meaning we would draw Fibonacci from a high to a low, and then price, we would essentially be looking, at the 50% or higher. I probably wouldn't go, too high, because then once it gets past a certain point, it's probably going to manipulate and run a previous high or something like that. So you kind of got to make sure the high or low is set. And I'm not going to teach you how to do that here, but once the low or high is set, then you can go in and hopefully use that Fibonacci level. So when you look at my Fib levels, right, what do you notice is, actually, let me move this over real quick, because it's all, I purposely put it all the way on the right side. I don't want to extend the lines right now, just for the sake of the video. But right, when you look at my levels, guys, what do you notice? right, is my very first level is the 50%. I don't have the 38.2 or whatever the default is, the 24 point whatever it is. I don't even know what it is because I don't have it on there, right? The 50% is essentially my very first fib level. So that's the minimum that I'm willing to buy a retracement on. Now, typically it's going to be the 61.8, and given certain conditions or circumstances, it'll be the 78.6. But those basically are the three levels that I look for. So I do usually have the 88.6 as well, but that level is so uncommon. I just went ahead and took it off, and I've left it off for a while now. So it's just these three levels. So if I'm looking to buy, I never buy above the 50% level because it's not at that halfway point, right? When we negotiate price and meet in the middle, if we're more in favor on the seller side, I don't want to buy price. I think it's too high. Right? Everyone talks about buying low and selling high, but what exactly is low and what exactly is high? Well, I just explained it to you, right? 61.8% is considered low, right? 78.6 is considered low. Anything above the 50% to me is considered high, right? So we want to buy low, we want to sell high. So let's go ahead and go into the charts and look at some hindsight examples. One of the very first ones that I saw on this chart was a trade that I was looking to trade earlier this month on September 10th. Now, of course, there was level 3 news on September 10th, and there's a whole nother lesson on, what the news actually is used for and things like that, but I'm not going to really get into all of that. But what I will do is draw a Fibonacci level. So what we're going to do here is actually look at the structure for a second. And I'm not really big on structure. I know a lot of people are. So that's why I'm choosing to go with structure instead. So when you look at the structure of the market, right, look at those candle bodies right here, right? You see these two candles right here? See the bodies right there? Look what price does here on September 8th and September 9th. When you mark the bodies of those candles, okay, the bodies are closing below, this is, to me, a break of structure, right? And of course, if we were to take this off and actually look at a line chart, okay, it's pretty much the same thing. You have that low, and then price closed lower. The magnet tool sometimes kind of bamboozles me a little bit. Okay, so you see that the line is sloping down, so that to me is a quote-unquote break of structure. So if we were to get a retracement higher, right, moving forward, right, high, low, look what price does. So let's study the history. We have the high and the low, and that's why I use the magnet tool, because it just snaps right to the levels, and that's what I want. And I usually extend the lines to the right, that way the numbers are not in front of the wick, so it's very clean and clear and I can see it, right? So, right, using that logic of what I just told you, right, not looking at anything prior to the 50%, only the 50% and beyond. So logically, right, look what happens at that 78.6 level. When we broke this structure, we could be bearish moving forward. So it hit that 618 level, rejected pretty heavily. Now, I'm not saying that's supply and demand, because I firmly believe that is not supply and demand. Again, there was news, a lot of manipulation around that, and so that's what we saw here, right? Heavy, essentially market manipulation, all right? But moving forward, right, after that, the weekly closed here, and then the following week opened, and look what started to happen here, right? Price came into the 50% multiple times and was getting rejected, right? So price was essentially in favor of the short sellers, right? We broke structure, came, tested these levels that would be the buyers and sellers essentially meeting in the middle, right, for that negotiation, and price after that, okay, falls off. Not to mention that this is a fractal high too as well. So it's the logic behind the fib levels, guys, of buying low and selling high. And so we flipped that and shorted high, right? And then you would buy back lower. So that is pretty much what it is. Now, I do use Fibonacci on a lot of time frames, pretty much all of the time frames, okay? Here is kind of another example that I was watching earlier today, actually being September 25th. I was watching the London session, all right? And I was actually looking for a short up in here somewhere. So I didn't actually short the market. I ended up actually hopping on Netflix, go figure. So this actually was created, and then this was a very nice shorting opportunity. And let's take a look. If we take a fib from the high to the low, right? Look where price was rejecting from, the 50%. It didn't get to the 61.8%, and that's fine, because I already told you my minimum requirement is the 50% level. Now, there are other concepts, some of you probably already know or well aware of, that are added to this, of course, but this video is specifically on fibs, right, and the logic behind buying low and selling high. So that essentially was a very nice retracement to the upside for a really nice downside objective. All right. Now I will give you a secret. All right. I'll just throw this in here, and it's up to you guys to kind of figure it out. But we came to the conclusion that Euro USD was bearish here because of the British pound. Okay. So here's the British pound, all right? 5-minute time frame, okay, same pretty much amount of data, all right? And look what the British pound did as well. It basically made a high and then fell off. But we wanted to essentially short both of them. But how do we know which one to short, right? We need to short whichever one that is weaker. Okay, so I'll go ahead and show you British pound again. Here's British pound. Here's Euro USD. All right, I'm not going to point it out for you, but we came to the conclusion that Euro USD was weaker than British pound. So we would be looking to short Euro USD, okay, also known as fiber. And I always like to use the London session, right? I don't really trade prior to London, so here is 2 o'clock in the morning Central. There is pretty much an infinite number of possibilities when it comes to the Fibonacci level. I mean, I could really essentially draw these all day long. I mean, it almost really doesn't matter. I'll show you a buying opportunity, and I think we can actually go over indices today if you want. Well, we'll see. So looking for that break of structure again here, right? And this is just a small 5-minute time frame. I'm just trying to show you some more examples. I'm just freestyling it, okay? You have, if you switch to that line chart, right, when price makes a higher high here, right, because you have some highs, and then price broke that, you have a low, higher low, right, and a high and a higher high. So by definition, this would be an uptrend, right? So if you take this high, right, the higher high, okay, that's a fractal high as well. If you look and trade the or draw the Fibonacci level from the most recent low, okay, from the low to the high, all right, look what price does. It comes back. It does trade through the 618 a little bit. It comes all the way down to the 78.6 level. Now, it does spend a little bit of time there. I probably wouldn't have held that trade if I got into it, so I would have missed out. But nonetheless, the logic is still there. So the logic of low, high, not buying above 50%, buying that 618 or buying that 786, and look what price does, ends up making some more higher highs. Okay, so that's the logic. Buying low and then selling high here or selling high up here. All right, depending on, you know, various things like risk reward ratios and profit targets and things of that nature. There's a million different things that we could do. All right, but again, 50% or lower, right? Because we want to be buying price on the side that's more favoring the buyers and not the sellers. All right, so we'll look at one more. We'll look at the indices really quick because I'm a big fan of the index futures. Okay. All right, so here is today's price action on the S&P 500. These are the micro E-mini S&P 500 futures, the December contract. We just got done with the September contract, and now we're moving where the most volume is and where the most open interest is, which would be the December contract. So that would be MESZ 2020. All right. So looking at today's price action, okay, look what happens here. You have a low that was set here, and then you have a high, a set of highs here, right? Because you have highs, higher highs, higher highs, right? So here is the distinctive low out of all of this price action, and the high price comes down a little bit through the 50 down to the 618. How do you know that the fib level is being respected? Is by the candles closing above, right? When the candles close above the Fibonacci levels, that's usually a good sign. All right, and you usually don't want to see the candles close below. All right, and you can backtest that. You know, you can go through history or whatever you want. Okay, and then price goes higher again, retracement, and then pretty much all the way till the end of the day. So more logic. All right, even a small trade right in here, if we take this off, draw the fib again, you had some highs here, price closed above here, so that would be a break of structure. You have this low up to this high, price comes down to the 618, candles are respecting it, the bodies are closing above, and then price trades higher. Now typically I wouldn't buy this only because it's now near the lunchtime, and if I didn't get in earlier at the day, you know, near the low of the day, I usually wouldn't trade this. That's just kind of me and the way that I do things. You know, if I didn't get near the low, I'm not trying to chase price. It's not really chasing price, you know, if you know what you're doing. But I still feel that way sometimes, that I'm chasing price, and I'd rather just wait for today, you know, wait till next week to find a better trade than this. You know, obviously this would have been very well, but I'm just usually not comfortable doing that. So that's just me being open and honest with you. So there you go. So yeah, that's pretty much it, guys. Again, just to really quick, the recap, the secret, right, to the Fibonacci retracement tool is not the levels itself, but it's the logic behind what the levels mean. Buying below the 50%, which is in more favor of the buyers, or above the 50% in shorting opportunities for getting a short price in favor of the sellers and not the buyers. All right, so that is pretty much going to be it for today. I touched a little bit on time and price, right? We don't just draw Fibonacci's everywhere. I do like to draw fibs and play the retracements inside of the sessions, whether it be London or New York. All right, so that is going to be it, right? I hope you guys learned something, and I will see you in the next video.